Hello everyone, good evening. Welcome to this webinar on market outlook and positioning of HDFC Large Cap Fund. As you're aware, the first 6-7 months of this calendar year have been quite eventful, with narrative shifting rapidly from risk on to risk off and vice versa. At the beginning of the year, all the talk revolved around trade, tariffs, so on and so forth. By February, the talking point was the implication of AI on the Indian IT sector and how Indian IT could adapt to the changing dynamics of the tech sector. By March, things had completely changed, and from there on, it's been about the Middle East conflict, Strait of Hormuz, crude, and that's largely been the key talking point over the last 3-4 months. Recently as June, there were some green shoots on that front, with some signs of easing of that conflict, with the potential truce around the corner. But again, over the past few days, there has been a resumption in hostility between US and Iran. So things have again been quite fluid on that front. So with a lot of narrative shifting, with a lot happening in the market, we thought it quite in order to have a call on the market outlook, and along with that, have a discussion on few of our strategies. So today for the discussion, we have with us Mr. Rahul Baijal, who is a senior fund manager who manages our HDFC Large Cap Fund. He has a rich experience of 24 plus years in equity research and fund management. He has been with us since July 22, so roughly 4 years he's been with us, with a total work ex of around 24 plus years. So Rahul will be touching base on a lot of topics around macros, around markets, around valuations, flows, so on and so forth, and also the positioning of the strategies that he manages. So without much ado, I'll hand it over to him.
Okay, thank you so much for this opportunity. So I'll begin the presentation with the macros. As is the case at all points in time, there are always a few tailwinds and a few headwinds on the macro front in the equity market. And I'll summarize some of them, and then I'll go into detail into a few of them. And then I'll spend some time on the positioning of the HDFC Large Cap Fund, and then we can open it up for Q&A. So that's how the flow is going to be. So firstly, on the key tailwinds and the headwinds, if you look at broadly the tailwinds first, I think clearly as we look into FY27, we are looking at a year where nominal GDP acceleration is expected, because last year was a low base of inflation and we had nominal GDP growth close to 9%. Clearly, expectation is that we'll land up somewhere in the early double digit for FY27. So that's an improvement. And even on the trade deals front, we have seen good news flow emerging after the heavy trade war news flow, which began mid of last year with the US. We have seen signing of deals with the UK, and Europe is work in progress, and US hopefully should happen before end of the year as well. A lot of stimulus has been given in the form of GST last year, and it's showing up in good numbers, especially in the auto space. But the question remains, can we give more stimulus if required? I think that's an open debate. Valuations are a mixed bag, far more reasonable than before, but there are pockets which are a bit stretched, and I'll talk about valuations in more detail in the PPT as we go forward. Good news flow on the rupee front, especially the package which came out last month, and a big question mark on when will the AI-driven rally weaken, because whenever it weakens, I think it's good for India from a flows perspective. On the headwinds, like Ameya mentioned, just when we are thinking that we're getting a breather, it seems the oil price has flared up again. We're back in the nervous 90s of Brent, and this shall remain an overhang, I guess, in the short term until we are out of the woods for sure. That brings into question the earnings growth outlook and the earnings downgrade concerns on the back of margin issues for various companies, which oil and derivatives can impact. We're already seeing some signs of that in the first quarter results, which have begun. El Nino worries is a bit new on the rural front, and jobs clearly is a multi-year concern in terms of job creation and good wage inflation. Again, FI flows have been missing in India for many years, and I'll spend a lot of time on this as to why I think I'm quite hopeful that these should turn positive before end of the year. And obviously, uncertainty around tariffs, flip and flop continues. So these are the key broad tailwinds and headwinds, and let me go a bit deeper into some of them. So, firstly, if you look at India over the last 2 decades, this has been my journey as a fund manager, and I see that the last 10 years, I think we managed the macros fairly well across all these indicators. And it was only around COVID we had issues around fiscal deficit, but even those we have sorted over the course of years. And as we look forward, we again are looking at a 6.5% kind of a growth with the 5% inflation and fiscal deficit anywhere ranging between a 4.3% target or maybe a 4.7, 4.8%, depending on how much stimulus, how much support is required, depending on where the oil price heads in the short term. But just to give perspective, we had a lot of yellows in the previous decade, and a lot of these yellows happened around 2010, 11, 12. And this is the stretch when oil price was actually $100 plus for almost more than 3.5 years. So the point being that oil price is important for India, and if it remains high for a prolonged period, it does cause a lot of yellowness in various macro indicators. Why nominal GDP growth is important? Clearly, we have seen in India that over the last 10 years, the index returns broadly mirror the earnings growth, and the earnings growth has a strong correlation with the nominal GDP growth. Therefore, how long we can grow at 10-11% nominal GDP growth over the next couple of years, I think has important implications for how equities will do well in the medium term. And one point I wanted to make, which gets missed, is that I think India, on a macro level, has broadly debt levels which are controlled, whether it's the government debt, whether it's the corporate debt, or whether it's the household debt. But if you look at other countries like China, between FY08 and the last 17 years, the government debt has shot through the roof. So is the case with the US. But in China, even the corporate debt and even the household debt, all three forms of debt are very stretched. Whereas in the US, it's only the government debt which is causing problems. The corporate and the households are broadly fine. But in India, actually, all three levers of debt, I think, are available over the next 5-7 years for us to sustain growth. So I think this is an important point to keep in perspective when one talks about visibility of growth for the next 5-7 years. Then coming on to why FIs were kind of absent in India over the last few years. I think, firstly, oil has been a key reason, especially over the last few months. Ever since the oil price went up, we saw outflows pick up from March onwards and heavy outflows. And things were looking up in the last few weeks when traffic picked up again. But again, we have seen the traffic in the last few weeks from the Strait of Hormuz has gone back to these levels again. And clearly, this is important, monitorable, because out of the 5 million barrels we get daily, we need daily, around 2 million barrels, 40% of that comes from the Strait of Hormuz. So any bottlenecks over there will create issues again, which seem to have got resolved in the last few weeks. And a high oil price also impacts the sovereign yields, like has been the case. We went to 7.1, then we came back to 6.7. and now we seem to be rising a bit again. So clearly, getting an oil price back to a 60-70 kind of a range, I think is critical for the India macro story to remain healthy. And I think many FIs will wait for that. Even 70-75 should be fine, but I think the moment it crosses 80s and especially the 90s, I think many FIs start getting nervous. So that's one. The second thing is the rupee front. If you look at our currency, we had a very steady rate of currency depreciation. If you look at the last 5 years, 3 years, around 5% range, longer term, 15-20 years, also around 4% plus minus. But over the last 2 years, rupee has moved from almost 84 to 96, which is a depreciation of about 15% in like less than 2 years. So clearly, it's been a very sharp pace, and actually, many FIs, by not investing, have actually not lost 15% in dollar returns. So it's helped them. But my sense is, I think the worst is behind, and especially because if you look at the REER, it's again a multi-year low, more than a 10-year low. But more importantly, I think a lot of measures have been taken by the government and the RBI over the last few months to ensure that currency remains stable to in an appreciative mode in the short to medium term. And I'm in that camp which believes that is the case. So what are these measures? I think if you look at our balance of payments over the last 2 years, they were negative, and we are staring at a potentially third year of it being negative. The problem was mainly the capital account over here, and the current account was okay. So, three measures have been taken on this front. Firstly, you would have seen that the FCRB inflows are expected and the ECB loans are expected. Both of these items should boost inflows by about 50 to 70 billion dollars. So that's the expectation before September end. We've already had a good start. The news which came out a few days back, already $20 billion plus minus has come in, and we are still 40 days into this window, and 80 more days are left before September end. So I'm quite hopeful that we shall land up somewhere in the 50-70 billion dollar range, which should be quite healthy. Secondly, portfolio investments on the fixed income side, the capital gains for investing in G-Secs has been abolished, and the width of bonds in which the FIs can invest can also been widened. And there is a chance that the Bloomberg index may also include Indian bonds. So again, this should help inflows on the bonds front. Thirdly, on the equities front, which I'll talk about, I'm quite optimistic that things will pick up. And lastly, on the repatriation, we have seen a weak IPO market actually leading to less outflows in the last few months. So clearly on the capital account front, quite hopeful that things will look up, and this should aid the strengthening of the currency, in my view. On the exports front also, we have done a lot of deals. Next 2 years, a lot of these UK, US, European FTA deals should help boost exports. And on the oil front, we are trying to increase the EV mix. And on the gold front, we are discouraging the imports by reducing the pace of imports by increasing the import duty. So I think a lot of measures have been taken. So that gives me confidence that there's a high chance that the worst from the rupee front is behind. And that is the second reason why I think many FIs will get positive on India. Thirdly, on valuations, especially the large caps where bulk of the FI money comes in. Now, if you look at the forward multiples, they're actually gone into the discount territory after a long time, which makes them attractive. If you look at valuations of India versus the other emerging markets, we've always traded at a premium. The premium used to be high, but now that premium has come down more in terms of the long-term averages. So that's positive. Even the broader market, while the headline uh, indices trade at a premium, but clearly the premium has come down significantly from the last bull market peak, September 24 levels. It used to be in the early 60s for mid caps. It's down to somewhere in the mid teens. And even in the small caps, the premium, which used to be close to 50-55%, is down to somewhere in the 20s. So clearly, valuations have moderated across the space. And if you look at them 2 year forward, the attractiveness improves even further. So on the back of all this, and plus what was happening due to AI in other emerging markets, we saw that last 1 year, from June 25 to June 26, two markets in particular attracted bulk of the inflows, especially Korea and Taiwan, and that led to continuous outflows in India. And you've seen a multi-year underweight emerge in India in that stretch. And incidentally, in the previous decade, if you look, a lot of people question the attractiveness of India in the emerging market. But I just want to remind the viewers that between June 15 to June 25, for 10 years, India was the second highest dollar return market after Taiwan. It's only in the last 1.5 year stretch that then there were other concerns on India, and the FIs were busy playing the AI trade in rest of the markets, that India has gone a bit out of favor. But I think even this can change, because as you can see, we are seeing a lot of volatility and the returns from AI tech capex being questioned. Korean stocks, like the two stocks in Korea, which are up 5x and 10x over the last 1 year, are already corrected more than 30% from the June highs. And even the most sought after IPO in the US last month is below its IPO price, which has a business model around AI and space. So there is clearly some cool off happening, and I think if the cool off continues, I think that should be favorable for India as well. So on the back of all this, we have seen huge outflows from India, and the FI shareholding has come down to around 16% levels, which is a 13-year low. Uh, but my sense is that things will get better as the rupee outlook confidence comes in, once oil goes back to that 70-75%, 70-75 Brent or below range. Valuations are already reasonable. The AI trade could weaken. I'm quite optimistic that this will turn more meaningfully positive before end of the year. In fact, in the last 1 month, we've had a few $1 billion come in as well. But again, oil has spiked up, so it's taking a pause again. But I'm quite optimistic that this should come back before end of the year, and that should aid the large cap performance, because 60-70% of the money which FIs put in goes in the large caps. On the US front, I think things are fine. No real concerns. Broadly, the growth outlook is around 2%. Unemployment rate is under control, and inflation is a bit of a concern. But again, the view over there is that the US also would be keen to bring the oil price to below $70 before the midterm elections. So that should help them as well as India on the macro front. So that's some detailing of why I think FI inflows will pick up meaningfully before end of the year, as four of these concerns get addressed. Then coming on to the large caps, clearly they've given compounding, steady compounding over the long term. And if you go a bit deeper and you look at a 20-year stretch, large caps have actually outperformed the broader market in 8 out of 21 instances. And we have cycles in the marketplace. like in 14, 15, 16, 17. For 4 years, you saw the broader market outperform, and then 18, 19, the large caps outperformed. Then came COVID and the recovery, and the broader market picked up pace again. And then in 22, we had a phase of large cap outperformance. Uh, then again, we had a mega bull market, which ended in September 24 with the broader markets outperforming. And again, a phase of correction last year where the large caps outperformed. And given where the price performances and valuations are, like I said, I think at this juncture, the large cap valuations are clearly looking more attractive. But having said that, I think there is enough scope for stock picking now across the marketplace because there has been correction in the broader market as well. So I think it's going to be a stock pickers market like it has been over the last 1 year. I think that trend will continue. And there are opportunities across the market cap spectrum to build portfolios. Valuation I've already talked about. Then coming quickly to the large cap fund and its positioning. Uh, so in terms of strategy, as you know, I've been running this for about 4 years. I complete 4 years, in fact, next week. The approach being followed is a blend of gap and value, and a very strong bottom-up approach blended with top-down sector and macro trends. And while doing bottom-up selection, I pay a lot of attention to the company's positioning and trends in the business sector and valuation cycles. A lot of emphasis on valuations, very valuation conscious, and the idea is to create an optimally diversified portfolio with a medium to long-term approach. There are some risk management guardrails also in place. Uh, like I said, there is optimal diversification, there is measured sector deviation on versus the benchmark, and a few high connection bets, contrarian bets are regularly taken with constant evaluation of the risk reward. And some of them, which they click, then it leads to reasonable alpha generation. If you look at the number of stocks over the last 4 years, you'll find the average number has been between somewhere between 45 to 50. And by product design, we don't have any small caps in this product because we are sticking true to label. And the churn also has been somewhere in the 15 to 25% range, depending on which year you're looking at. And the benchmark overlap throughout the 4 year journey has been at least 50%, like was the case in the earlier 10 years before I started managing this. On sector positioning, this is the latest positioning. Strong overweights on healthcare, consumer discretionary and financials, and telecom, and large underweights in IT, FMCG, energy and materials. And especially the large underweight in IT has been the case for more than a year now, and it's really helped in the last 6 to 12 months. Then just a quick a summary on how it's performed over the last 4 years. So I'll split this performance into three phases. I think the first phase was between July 22 and September 24, bull market. Here, the growth value mix used to be somewhere in the 50-50, and this fund captured a bulk of the value rally, which happened over here. And then between September 24 and September 25, this year has been a phase of consolidation for the fund. A lot of churn happened, and the growth value mix change. At the end of this churn, the growth value mix has shifted significantly in favor of growth, around 85% versus 50% over here, and with a heavy private sector bias and a heavy quality bias. So that's how the fund is positioned for the next upcycle. It's the growth value mix is around 85-15, heavy private sector bias and heavy quality bias for the next upcycle. Um, so I've given you some flavor on the macros, the tailwinds and the headwinds, gone deeper into a few of them. and given you some perspective on the positioning of the large cap fund and the performance update. I'm happy to pause here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.